Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. So the stock market did really nicely this week with a risk on sectors like consumer cyclicals up 5.5%, industrials and technology up 4%, energy and basic materials up 3.5%, financials up 3%, real estate 2.7%, and then the more risk of defensive sectors like consumer defensive, healthcare, and utilities were the laggards. And we had communication services, the only sector closing meaningfully in the red this week, down 1% off the heels of that horrible report from Snapchat. They missed significantly on revenues and on profit. And in fact, they even refused to give a forecast for the upcoming quarter. So investors really hated that and they punished the stock. And the stock is down 30% off the heels of that terrible report. Taking a look at the stock market map, we can see a few pockets of red, including communication services, specifically Google, and telecom companies, healthcare and healthcare plans, so healthcare insurance companies. Some consumer defensives were down, some consumer defensive stocks were up, so it was a bit of a mix. Utilities are largely down to flat. Tech did really well except for a large cap tech like Microsoft and Apple. The riskier parts of the tech sector like semiconductors and software did really well. Financials did well despite the terrible earnings from the banks, the big banks. And we also had industrials perform really well and basic materials doing well. Telecom services took a really big hit after reporting that a lot of people were actually missing payments on their phone plans, which is not a good sign, right? It's a sign of a weakening consumer. So if you can't pay your phone bill, are you going to spend money buying stuff from Apple or Microsoft? Are you going to spend money traveling around? Probably not, right? If you can't afford a necessity like your phone bill, that's a really, really bad sign for the economy, especially regarding the lower end consumer. And remember, guys, this is what tends to happen when inflation rises up. The most vulnerable in our communities are the first to suffer, and we are seeing that now. But again, if inflation continues to be high, and we start to see a weakening jobs market, that will really be a sign for further weakness to come in the middle class. And as we all know, the economy is built entirely on the middle class. Now let's take a look at the daily chart for the S&P 500. The S&P 500 closed 1% down, largely dragged down by that terrible report from Snapchat, which had a negative impact on the entire communication services, along with those terrible earnings from the telecom companies that pushed the entire stock market down. We haven't yet managed to close the gap at 401.5, so this is still my target. I would like us to see this gap filled and even overshot to the upside. Perhaps on Wednesday after the FOMC meeting is concluded, we might see a last squeeze where we close this gap and overshoot to the upside and perhaps hit the upper boundary of this descending channel. That would be a perfect spot to exit the market if you were in this rally, or if you're actually thinking about shorting the market perhaps. The last time we had the market hit this upper edge of the descending channel was right here back in late March. And then we continued to see weakness and chop, and then finally the market gave out and had this precipitous sell-off. So that's what I'm expecting. I'm expecting some more chop, a lot of volatility coming in this week because we have a lot of economic numbers coming out. We have the GDP figures, we have manufacturing numbers coming out, we have the FOMC meeting, and we have so many big earnings coming in. Apple, Amazon, Facebook, Ford, Alphabet, Microsoft, Coca-Cola, UPS, NXP, Intel, ExxonMobil, Chevron, so many massive companies reporting. On the triple Qs, we actually filled this gap way back here in the beginning of the trading week. Then we overshot it. We are getting really close to my pivot point at 312. Again, we're getting really close to the upper edge of the descending channel. Last time we hit that descending channel, we had a second touch or a second test, and then we had a massive sell-off. We might see something similar play out again after that FOMC meeting. And we're actually forming a bear flag right on the weekly chart. We had this flag pull, then the flag, and then we sold off, and then we have another flag right here that could potentially break to the downside. Same thing on the S&P 500, guys. On the weekly chart, we have this really well-defined bear flag. right? We had a bear flag here. This is the flag pole. Then we had the flag, and then we sold off. Another flag, sold off, another flag. This is a fairly well-defined flag with a clear lower boundary and an upper boundary. The upper boundary sitting at about 403. We could see an overshoot again to hit the upper edge of the descending channel, and then we might see a sell-off. Now let's take a look at the Russell 2000. The Russell 2000 was actually showing some nice signs of strength, but then we had that sell-off, and then we had a we had that rally slowing down on Thursday, and then we had that sell-off on Friday. We haven't managed to close the gap at the $183 level, 183 and a half. We're getting really close. So again, I expect to see something like this, right? Fill or an overshoot and then a sell off. The Russell is starting to show some signs of basing, right? We had this divergence on the MACD where we had a lower low on the daily chart, and then we had a higher low on the MACD. This divergence resolved to the upside in this rally that we are seeing. We've actually already hit the pre-pandemic highs. There's a really good chance that we might be starting to form a base here. If we get another low right here in September, and then we see another positive divergence on the MACD, that in my opinion would be a great entry point to the long side. Remember guys, seasonality for midterm years, we tend to have a sell-off towards the end of June. We actually did have that. We haven't managed to break the lows of June yet, but what tends to happen in those midterm years is we have the summer rally. The rally then ends sometime in early August, and then we start to see a second leg of selling where sometimes we make a lower low compared to June. For example, here in this red chart, which represents the second year new Democratic president, and then same thing in the purple chart where we make a lower low at the end of September. But if we look at all the midterm years, the blue chart, we actually make a higher low in the back half of the year at the end of September. In my opinion, we will likely see a lower low in the S&P 500, and we might see a higher low in the NASDAQ. And this is why, guys, this is the triple Qs, the NASDAQ divided by the S&P 500. This is a ratio chart. Again, we've been going down through this descending channel really nicely. We are now touching the upper edge of the channel, and then we had a rejection right there. So next week, I do expect to see a lot more weakness to come into the NASDAQ, the triple Qs, stocks like Microsoft and Apple, Google as well, Tesla, really big names. I expect to see them to start selling off next week. And just look at this, guys. This does look like a bear flag. We had a bear flag right here, flag pole, and then this is the flag. Another flag right here, flag pole, and another flag. So what you would want to see is for probably a second test of the lows right here at 0.73 towards the end of September, where we form a bottom right here on the ratio chart, and then the NASDAQ begins to pick up and then starts a nice holiday rally in November, December. The way that I'll be looking at this is I'll be looking at the momentum to make a higher low, right? I expect to see a similar low or perhaps an undercut, maybe an undercut right here, and then a higher low on the MACD, and that would signal a beautiful entry point into tech stocks, into the NASDAQ in general. Now let's take a look at the VIX. This is a daily chart of the VIX. We are getting really close to the lower edge of this ascending channel. The last few times that this happened, we saw very significant selling in the stock market and a massive jump in volatility, right? Massive spikes. These are massive spikes that brought us back all the way to 35. This happened every single time. We've actually gone down towards the lower edge of this ascending channel. We are getting very close here, guys. So here's exactly how I expect this to play out. This is just a scenario that I have in my head that makes sense to me, okay? My expectation is we will chop around, and then on July the 27th, I expect to see a last break to the downside in volatility. After the FOMC meeting is concluded, I expect to see a rally in the S&P 500 and a decline in volatility where we touch the lower edge. And then on the 28th of July, on Thursday, when the GDP figures come out, I expect to see the VIX to start moving up again, okay? I do expect that the GDP figure for the second quarter will be negative. That will officially put us in a recession. Why? Because we had a negative print in the first quarter, and 2 consecutive quarters with negative growth defines a recession, okay? That would mean that we've been in a recession for 2 quarters so far. So I'll be looking at that. I'll be looking at the volatility to get absolutely crushed after that FOMC meeting. I do not expect any surprises. The Fed has pretty much told us to expect a 75 basis point hike. I do expect them to deliver that, and that will not be a surprise, and the market will probably rally. And that's when I expect us to at least fill this gap and perhaps overshoot it to the upside, touch the upper edge, and that will be the last part of this bear market rally. Let's take a look at the 10-year yield. The yield is now officially has topped. In my opinion, we've officially topped. We got really close to a bullish crossover that did not end up happening. We sold off. Now this slowdown in yields, this sideways chop in yields, was very positive for the stock market, specifically tech stocks, right? When yields calm down, the stock market moves. And then when we have a massive decline in yields such as this, what this tells us, guys, is that money is flowing into bonds. And when money flows into bonds, it means that investors are super worried about a recession. So in fact, a crash in yields would be negative for the stock market. It would signify extreme fears. Okay, so that would not be a positive for the stock market. Generally speaking, low yields, strong bonds are positive for the tech sector, but a crash in yields and a massive surge in bonds is negative, okay? Because again, it signals an exit out of equities, out of stocks, and a flow into bonds, into safety assets. So this sudden drop in the yields basically tells us that the stock market now officially believes that we are in a recession and that the GDP figure for the second quarter will be negative. Okay, so the market is preempting that release, and that's why we are seeing weakness in the stock market on Friday, alongside many other factors. Let's take a look at the dollar index. The dollar index remains in a negative momentum. We are trying to hold this 20-day moving average. The last time we touched it, we saw a quick bounce to the upside. We're now just holding. We might see a continuation of the weakness in the dollar as yields continue to go down. Remember, guys, when yields go up, the dollar goes up. And when yields go down, money flows into bonds and out of cash, right? So in terms of safety, you always have many choices. You have things like gold, you have things like cash, and then you have bonds, okay? What tends to happen in a bear market and in a recession, money flows into the US dollar, okay? In the first half of the sell-off, in the first leg of the sell-off, and then money flows out of the US dollar and then flows into things like TLT, so long-term bonds, and then the dollar goes down, bonds move up, and the entire stock market also moves down. Now let's take a look at the daily chart for Apple. Apple is trading absolutely perfectly within this descending channel that we have drawn up. We have now hit the upper boundary of this resistance channel, and now we're seeing a rejection. We are also seeing this rejection right at the upper edge of this sell zone. This is a pivot zone, guys, where we had selling, support, support, and then we broke through that support right here, and then it's been resistance, and now the last part of this resistance after this massive rally in the in Apple. This was a pretty sizable rally, guys. We're talking about nearly 20%. The last time this happened to Apple was right around here where we had that 19% rally in Apple. And that was, again, similar to right now, was right ahead of earnings, right before the earnings came out. And then Apple proceeded to sell off after those earnings came out. I expect the exact same thing to happen. My base case scenario is a retest of the $130 to $135 level. So a retest of the lows again. That is my base scenario. The more bearish scenario is we undercut that low into the middle of September and then we hit $120. That would correspond to this cluster right here at $120, which I believe is a pivot point, an important pivot point, because it was resistance once and then it was support several times. Okay, so base scenario $135 to $130. Bearish scenario, we go down to 120. And the bullish scenario is we actually form a reverse head and shoulders and we never end up touching the lows again, and then instead we stop at $135 and we stay above this a red line right here. This red line, guys, cuts the price action of Apple into two halves. A bullish half right here where we are above the red line, and then a bearish half where we are below the red line. Let me just get rid of all of these. Okay, so this is much better. Okay, so again, the bullish scenario is we have a reverse head and shoulders where we have the left shoulder right here. This is the head and this is the right shoulder. And that would be that. We bottom here and then we see a rally from there. I do favor the double bottom thesis more. I expect to see this low to be hit. I will position myself on the short side. I will be buying puts. In fact, I will be converting my puts into a put spread, and I will be targeting this $135 level to take profits. So even though I expect a second test of the lows, I'm going to trade this more conservatively. Now let's take a look at the Semiconductor Index, the SMH. Look at this absolutely beautiful chart. We've tested this channel once, twice, and now for the third time. We sold off every single time. And I do expect a second sell off. Now I do follow cycle analysis, guys. Ask Slim. Please check his videos out on YouTube. Cycle analysis is suggesting that semiconductors are possibly bottoming. Okay, so this might be a bottom. What would confirm this bottom, or would help to confirm this bottom, is if we actually see the upcoming pullback come at the 50% retracement level or the 38 fib retracement level and does not undercut that level. Okay, we need to stay again above this red line. This red line represents bearishness below right there and bullishness above. Okay, beautiful. So if we see a tag of this descending line and we see a bounce back up, in my opinion, that would be a bullish sign. That would probably mean that semiconductors have in fact bottomed. Now another clue that semiconductors may have in fact bottomed is this black line. This is the 2-year moving average, the 730-day moving average. I haven't seen anybody use moving averages that go back this long, but I do because I found them very, very useful. Why? Look at that. Systematically, every time we've hit this moving average, we've seen significant buying in the semiconductors. Okay, and we've actually already hit that line right here. We undercut it and then we pushed back up in a very impulsive move to the upside, which is very bullish in my opinion. So we've already seen that line being hit right here. And if you guys remember the last couple of weeks, I've actually been suggesting that we've actually been in a beautiful, beautiful place to accumulate AMD and Nvidia shares. That is still absolutely my belief. And now I'm seeing more and more corroborating evidence that this might be the bottom in the semiconductors. Remember guys, different parts of the stock market bottom at different times. And what tends to happen is that sectors that tend to top first, right, are also sectors that tend to bottom first. And in fact, look at that. The first sector to ever top was the high growth part of the stock market, the ARK Invest ETF. It topped right here in Feb of 2021. And we have actually now made a bottom right here in May. We have not undercut this low, despite the fact that the S&P 500 undercut this low in June. We did not on ARK, on the high growth areas of the stock market. So we're seeing a bottom in May, and in ARK we're starting to see a bottom in the semiconductors. And in fact, the Semiconductor Index is the best performing part of the stock market and has been for the past about 8 to 7 years. And that's why I'm really, really interested in the Semiconductor Index. It's also where I got my start as an investor and where I got my start. I actually did work in this industry and I have deep knowledge of the semiconductor industry, specifically the gaming and PC parts of the industry. So let's see what this looks like on AMD's chart and just look at how absolutely beautiful this touch is. I mean, you could not make this up. I swear I did not move this descending channel. I left it as is. It's been sitting here since March, in fact, late March. So I did not touch this descending channel at all. And then you have this ascending long-term channel. This channel goes back, guys, all the way to 2016. Okay, we've been trading within this range perfectly, right? We touch the top, we go to the bottom, we touch the top, boom, we go to the bottom. Okay, So this is a tremendous buying opportunity in AMD, and I did in fact load up on AMD shares as an investment, not as a trade, as an investment right here at $77. I bought a lot of AMD shares. In fact, I bought $100,000 worth of AMD shares at 77 bucks. So it's a pretty sizable position for me as an investment. It's a really big position. And we ended up bottoming right here just a couple days later. So I got really lucky. This descending channel did help me so much, as well as this ascending channel. So that worked out really well, and I'm so happy about that. I did actually also get into AMD, into the AMD options right here at the very bottom. So in addition to the investment right here, I did buy AMD options, and then I got out of those options right here. I did not get back in. I missed this trade, this move to the upside. Unfortunately, I did miss it. But now I will be looking to add to my investment, and I will be looking in fact to add to my shares, as well as buying leap options. I'll be looking at buying leap options on AMD. Again, as long as we start seeing AMD bottoming. So if we see a test at the 50% fib retracement level, and what would be even better is if we see a test of the 62% retracement level right around here. That would in fact form a head and shoulders pattern, right? Where we get a shoulder right here, this head right here, and then a second shoulder right here. I do expect to see the second shoulder right around early September, mid-September, so right around here, okay? And that would actually be a second test of this channel. And if we see a bounce back up, that would be the signal to go all in, okay, on semiconductors. AMD is my favorite name. AMD has been the fastest growing large semiconductor company. It's actually been growing faster than Nvidia, both on revenue and on profits. I'll in fact make a separate video specifically about semiconductor companies. AMD is my favorite out of all of the semiconductors. Nvidia comes at second place. I do like me some Nvidia as well. The advantage that Nvidia has over AMD is the brand image, okay? Not just as a product, but also as a brand in the investment community as well. Investors seem to love AMD. They seem to love Nvidia even more, and that's why it carries such an insanely high valuation. The valuation has come down significantly. It's now significantly more reasonable, but AMD is still cheaper and it's growing faster. That's why I like AMD more, but I also like Nvidia. I will be looking to accumulate Nvidia shares. I think that Nvidia could easily retest the low again, okay, at around $140 to $150. I think that's possible because Nvidia tends to trade a little bit more like a software company, a little bit more like a large cap tech company, and a semiconductor company. So it's a bit of a weird mix. Sometimes it outperforms the semiconductor index, sometimes it underperforms the semiconductor index. Over the past several months, it's been significantly underperforming the semiconductor index and other semiconductor stocks, including AMD. So I do expect to see some more weakness in Nvidia that would allow me to accumulate shares at this lower border. Again, guys, this is a similar channel to what I drew up on AMD. I've had this channel drawn up for years now. It goes back into around early 2016. The last time we touched the lower edge of the channel was in early 2019 after that massive Christmas sell-off in 2018. And Nvidia has been on a massive tear to the upside ever since. Again, I'll be looking at buying some Nvidia shares as we get closer to the lower edge of this channel, as well as leap options. I will be looking to buy the furthest out option expirations that I could find. And again, I'll be talking more about that in my semiconductor special or chips special video. I'll be making a separate video that talks about how to invest in chip stocks. Now let's take a look at this beautiful chart right here. This is a semiconductor, this is the semiconductors divided by their triple Qs. This is a ratio chart, and I'm bringing this chart up because I'm still waiting for a touch of this 200 weekly moving average. The semiconductor index is in orange, right? The chip stocks tend to bottom very soon after we see a touch of the 200 weekly moving average. Right, we had a touch right here in October of 2018, and then we had a bottom in December. Same same thing really here, guys. We had a touch of the 200 weekly on in May of 2019, and then we bottomed. Then again here, 2020 March, during the pandemic crash, a touch, and then we bottomed. So I'm waiting for a touch right here. Probably we will see this touch in September. That would be my guess, where we see a second leg and the final leg in the sell-off in the semiconductors. Then we bottom right here in September, and then we rally. Okay, now let's take a look at another ratio chart. This is growth divided by value, and as you can clearly see, value has been significantly outperforming growth ever since we put that stock market top, the S&P 500 top, in early January. We've seen significant selling in the growth sector, where we had these bear flags, right? Flagged, we sold off, and now we're flagging again, and we are seeing this rejection right at that, again, 2-year moving average. This is the 2-year moving average. I've not seen many people use this moving average, but I have been, and it's been very useful to me. So we're seeing this absolutely perfect rejection right at this 2-year moving average on growth divided by value. So I do expect to see some more weakness in growth to come in as we see this last leg of the sell-off and the bottom in September, right? What I'll be looking at is for the momentum to also go down, but form a higher low, right? A divergence where we make either another low, right, where we undercut the low in May, or where we simply test this low again, but form a divergence, again also pointing towards a bottom in September in growth stocks. Now let's take a look at another ratio chart. This is the XLY, consumer discretionary, divided by the S&P 500, right? And I'm bringing this chart because it's actually been very helpful in predicting significant selling, okay? And what I mean by that, guys, is that we tend to see the ratio bottom just before the last leg of the sell-off, right? Where in 2008, during the financial crisis, we actually formed a triple bottom. The last bottom was right here at the bottom of the stock market. And then we had this beautiful divergence, right? So even as though we've been testing the bottom again and again, we've actually been making higher lows on momentum. Same thing here, guys. During the 2000 to 2003 recession and market crash, we bottomed right here at the earliest part of that sell-off, and then we saw significant selling. Okay, we're seeing the same thing happen today, right, where we are bottoming right over here. We formed a bottom right here, and this suggests to me that we will see a continuation of selling in the S&P 500 and perhaps some consolidation in consumer discretionary stocks, because we've already seen consumer discretionary, for example, Amazon, already hit the pandemic lows. So discretionary is basing, and that usually happens ahead of the rest of the stock market. Because remember, guys, the parts of the stock market that top first, right, are also the ones that begin to bottom first. So consumer discretionary topped around the middle of 2021. And then the stock market, the S&P 500, topped in January, right? January 3rd, I believe. So I would argue that we are at the later stages of this sell-off in the S&P 500, and we will start to bottom. Again, my timeline is around September. This is another beautiful ratio chart, XLY, consumer discretionary, divided by XLP, consumer staples, the defensives. So I'm looking at a similar development here come in the upcoming couple of months, in August and in September, where we see the stock market form a lower low and then the ratio form a higher low, okay? That would again be another signal that the stock market has bottomed and it's time to go full long, okay? We are also seeing this bullish crossover on the PPO, the momentum, which signals that we have either seen the bottom in consumer discretionary or we're getting super close to the bottom. And therefore, we are getting close to a bottom in the S&P 500. Now, the way to explain what is happening here, guys, is that defensive stocks, consumer staples, tend to continue to move up as the stock market is declining. So at the early stages of the bear market, consumer staples continue to move up as the stock market is declining. But eventually, these staples start to roll over when we are getting close to the stock market bottom, right? When the stock market begins to bottom. these consumer staples also begin to sell. In contrast, consumer discretionary tend to sell off well ahead of the stock market. So this is the stock market selling off, and then consumer discretionary tend to bottom ahead of the stock market. And as the stock market begins to recover later, consumer discretionary is actually moving up as consumer staples is moving down, which drives this ratio to the upside, right? So people get out of defensives and then they move into the stocks that have been beaten down, consumer discretionary, the high risk stocks. So you get rid of your defensive moves, your defensive positions, and then you get into riskier stocks as they've bottomed. And that's when you see this ratio move to the upside. Now let's take a look at Tesla. Again, a beautiful, beautiful chart here. Tesla touched the lower edge of this pivot zone that I've drawn up. I've actually had this pivot zone drawn up for quite a while because I've been waiting for Tesla to fill this gap. We haven't filled the gap yet. So we might see some chop and then a fill of this gap on the 27th on the FOMC meeting release. And then we see a sell-off, right? This does look like a massive, 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 massive bear flag in Tesla. And it's important to point out that Tesla's earnings were actually pretty bad, right? Profit margins declined significantly. Their forecast has weakened, and it was because of the China lockdowns and weakening economy in China. So I am not bullish on Tesla just yet. I do think we could see a second leg of selling in Tesla, and this does look to me like a massive, massive, massive bear flag, where again a full measured move on this bear flag, assuming that we top right around here, would take us to around the $400 level, close to this cluster of trading right around here. Okay, so if you want to go long Tesla, if you're not in the name already, I would consider waiting a little bit more as we get into that September timeframe and then look at Tesla. If we happen to find Tesla hovering around the $400 to $500 level, I would say that would be a good entry. That's just my opinion, okay? And in fact, if I was in this trade, which I'm not, okay, I do not tend to buy stocks or options ahead of earnings. I'd like to react after the earnings because of the huge implied volatility. If I was in this trade, I would actually be taking profits here. But again, that's just me, and this is not financial advice. Now let's take a look at AMC. AMC has actually been selling off. We haven't managed to hit this 200 daily moving average, unfortunately. The stock market dumped on Friday, and we saw AMC dump alongside the entire stock market. There could still be some steam left in this rally, especially as we get closer to that FOMC meeting day. We might see that last pop in AMC on Wednesday. We will have to wait and see. But this selling has also been exacerbated by the fact that GME, GameStop, has already split, and I expect to see weakness to come into GameStop now after the stock split is out of the way, okay? Because stocks tend to move up ahead of splits and then move down after the split. Now let's talk about earnings coming up next week. Things that I'll be looking at NXP. This is a semiconductor stock. I expect strong numbers based on all of the reports that we've seen so far. Microsoft, Alphabet, UPS as well, General Electric. I expect these companies to signal some type of weakness in the economy. Coca-Cola as well, right? I expect to see margins getting compressed, some pressure to the profit margins for Coca-Cola as they absorb more and more of that increasing cost due to inflation. Visa, I will be looking at Visa again for hints about what is the state of the economy, how far we are into this recession, how much the consumer has weakened or not. So Visa will be a critical report to look at. Then we have Facebook on Wednesday, and this report alongside Alphabet, Google, will probably make or break the communication services sector of the stock market. Because if we see weakness similar to what we've seen with Snapchat, that will be a very, very bearish sign for the economy. Facebook and Google are probably the biggest players in the ad market. So if we see a decline in ad sales, that means that companies are actually cutting their spend on ad, and that's a very negative sign for the economy. Ford, I expect them to have a horrible earnings report. We've seen delinquency rates in car loans rising sharply. Qualcomm will be really important. Again, a big player in the semiconductor space. They make so many chips that go into phones. So again, a weakness in forecast by Qualcomm is, in my opinion, a leading indicator into the state of the economy. Then we have the big daddy Apple on Thursday, as well as Amazon. So these will be absolutely massive market movers. Apple is already, as we've seen, has run into resistance. So I would not be going long Apple here at all. I would in fact be looking to add more shorts after the earnings come out and after the implied volatility is out of the way on the options. The options get much cheaper, and then you can buy put options on Apple for cheap and make a lot of money. Amazon, I in fact expect Amazon to do well, right? Because they had record-setting Prime Day numbers, sales. So I expect Amazon to do fine. Amazon has been basing for a long time now on the chart. So I think Amazon will do fine. That's my expectation. ExxonMobil and Chevron, I expect very strong earnings and a strong forecast as oil continues to hold around the $100 level. In fact, let's look at a chart for oil. This is crude oil. We did predict that oil will start selling off to the $100 level right after we saw this rejection. If you go and watch our earlier videos, we did predict this, and it played out exactly as we thought it would. We based right here, we had this massive rejection candle, and then we moved to the upside. I do expect that oil has probably based right around here. We will see oil chop around here for a while. We are seeing a bullish crossover here on oil. So I do expect energy stocks to start picking back up, especially if we continue to see signs that inflation is not cooling down. I do expect oil to hold at least the $100 level, okay, for a while, unless we get into a deep recession, perhaps into early next year. Now back to earnings. This is the beat rate on earnings. It's sitting at 66%. This is not a good sign. I mean, it's more than 50, but that's not a good sign. We tend to like to see this figure closer to 75, 74 plus. So earnings are definitely weakening. They're definitely slowing down. Even as earnings expectations have come down, stocks are still missing. Companies are still missing, and the companies that have actually been missing on earnings are kind of the canary in the coal mine, right? They tend to be leading indicators into what's happening in the economy, and I'm talking about financials, of course, right? So Wells Fargo missed, Morgan Stanley missed, US Bancorp missed, BlackRock, a money manager, massive money manager, has missed. A lot of banks are missing. In fact, if I just arrange the results by misses, they're mostly banks. They're mostly banks and real-world economy companies like airlines, like manufacturers, like travel and leisure. Okay, so these companies have been missing. And when you start seeing earnings weaken on these companies, again, it's a sign that the economy is weakening, and that's definitely not a surprise. Now, looking into this week, we do have a bunch of economic figures coming out. We have the Chicago Fed National Activity Index coming in on Monday. Then we have the consumer confidence coming in on Tuesday, as well as new home sales. Wednesday, we have durable goods orders. This figure, guys, tends to top and start declining as the weakness in the economy tends to accelerate, right? So if we see this figure come in below expectations, and the forecast is already negative, it's a negative number. So if we see an even larger negative number than 0.1%, that would be a really bad sign for the economy. We also have pending home sales, and then the most important event of the week and perhaps the year, the Fed funds rate. But again, the Fed has basically told us that it'll be a 75 basis point hike, so I do not expect a surprise here. On Thursday, we will have the GDP figure for the second quarter. I expect to see this come in at a negative number, so well below the forecast at 0.3. I expect it to sit around 1.5 percentage points down in the red, a negative 1.5 percentage points, and that's based on the Atlanta Fed forecast that we've seen already. Again, I expect jobless claims to continue to tick up as as more and more companies cut jobs and freeze hiring. And then on Friday, oh my goodness, on Friday, we will have the inflation figures come out. The PCE inflation, the personal consumption expenditures figure. And this is the most important figure for the Fed, because this is the preferred measure of inflation by the Fed, right? They use this figure to plan future rate hikes, and if this figure comes in below expectations, that's a good sign for the market. If it comes in higher than expected, that would in my opinion, be a super bearish signal and will probably send the market spiraling down back to Tesla lows. And not only that, we have consumer spending, okay, we have a nominal personal income, we have the Chicago PMI, we have the consumer sentiment, and inflation expectations. So Friday is going to be a nuclear day. It's going to be an absolutely insane day. So many fireworks on Friday, I bet. This is going to be an insane week. How insane? Well, take a look.
So what about you, Jim, ahead of what is a incredibly big week, given all the earnings that are coming, right? Yeah. Microsoft and Apple, Alphabet, Meta, Amazon, the Fed meeting Tuesday, Wednesday, GDP, a read as well.
It's kind of an overwhelming week, Scott, so we better get our sleep this weekend. And I'm not kidding. You asked me point blank, how do I feel about the markets? I said nervous, okay? And that may catch people by surprise because I've been bullish and I remain bullish in the long and intermediate term. But the truth of the matter is I see the risks that are out there. I see them.
And when you start seeing people like Dan Ives say they are scared, it means that people are scared, because that's a perma bull if I've ever seen one. He's been saying buy, as we've seen a significant selling come in. This entire bear market, he's just been saying buy everything. So he's a perma bull, and if the perma bulls are worried, we all ought to be.
What about you, Seach, as you look ahead to next week?
So I would say this, two things. Number one, don't read too much into this rally. We haven't seen any real change in the liquidity environment. Many names are overbought. They're heading towards their technical resistance levels. The 100-day moving average on the S&P is 4,100, so I don't know if we get to the 4,200. At that point, the markets will be trading in an 18 times PE. That's if you believe the earnings. The last time we were there, the Fed was cutting, not hiking. Number two, this rally was kicked into high gear starting with last Friday's University of Michigan sentiment survey. The bond market is now pricing in rate cuts in 2023, and the timeline for these cuts has been inching forward. The narrative is if the bond market is already pricing in rate cuts, traders believe that they need to be buying risk. We would say not so fast, because I think the Fed, you might see a deceleration in inflation activity, but does the Fed really want to make the mistake that Arthur Burns did in the 1970s and start to lower rates when nominal GDP started to decelerate? And it ended up exacerbating and prolonging the inflationary episode through the decade into the 80s. I think this Fed does not want to do that, and that's why we are decidedly cautious, and we would be using this bounce to start to think about how to protect portfolios.
The risk reward for the biggest stock in the market, says Jonathan Krinsky, Apple, looks quite poor to us. That's what he says. He joins us now.
The basic thesis here, it's had a 20% rally off the lows, almost identical to the move we saw in late March, which, by the way, was right ahead of its last earnings print. And so, the run up into the earnings print always makes you a bit cautious. And then we're also seeing some, upside exhaustion signals, just different metrics we focus on. I do think the risk reward is poor here. And the other issue is that it's kind of been treated as a safe haven. There is a lot of I would almost call it a little crowded as a long idea right here.
That's all I have for you today, guys. Thank you so much for watching, subscribing, and liking. And I'll catch all of you legends in the next one. Bye-bye.